Hey guys, it's Tony, and today I'm going to be showing you how to actually leverage Robinhood's algorithm to basically make you money on calls. So let's get to it, right? I don't know if a lot of people actually figured this out, but when you actually go into the menu of buying a call or buying a put, all it tells you is, to break even, all it tells you for the $61 call, for example, to break even, you need to hit 62 bucks. And to break even, you would need the price of NEO would need to go up 1.89%. The same thing happens when you're trying to buy a put. Same thing is going to happen. But what you don't actually see, what a lot of people don't actually see, is the chance of profit. So if I were interested, for example, in this $60 NEO, if I was interested in, let's say I was interested in a $100 call for NEO, right? What are the chances of this $100 call for NEO hitting on January 15th? All you would have to do is just actually go to sell a call, look at the chance of profit. The chance of profit for somebody selling you this call, their chance of profit is going to be 99.81%. So that means that your chance of, if you actually buy this $100 call, there's only a 0.19% chance of you actually making money. So if you buy this $100 call, if I buy one of these, right? Let's say I buy one of these for $1, the chances of me actually making money off of this $100 call, buying a call, would only be 0.19%, which is less than a percent. Obviously, the lower down you go on these, you have a greater chance of actually making money. So let's say, if you're interested in, you want to buy this, 0.5 call for NEO that expires, tomorrow, January 15th, you actually have an 18% chance of this heading profit. We can go to January 22nd and kind of do the same thing. I mean, you want to go for the ones that are actually, it's not an exact percentage, but it gives you a pretty good chance, a pretty good idea of what you can actually do. So if you're looking at buying a call for, January 20th, let's go a little bit far out. Let's go to March 19th, right? Because there's a lot of volume for March 19th. Let's say you want to buy a call for, actually let's go back. It's too far forward, right? Let's go February 5th, right? Let's say you want to buy a call for, NEO, 75 bucks. The chance of profit of me selling these calls would be 85%, which means that somebody on the other end that's actually buying it only has a 15% chance of this call actually hitting. The same thing goes when you go all the way down. So if I keep going all the way down, if we go to like, the lowest one that I can find is this $40 call for NEO on February 5th, which has a 56% chance of profit if I sell it to you. So on the other end, that means that whoever buys this has a 44% chance of this contract actually making you money or getting in the actual money. This doesn't mean that it's not gonna go up on premium, because it probably can, but this is just kind of an idea of a percentage of what you guys have and how you guys can leverage Robinhood's algorithm to actually profit. It's pretty simple, and it's fairly direct. So if you actually want to look at the chance of profit, just hit sell a call, go to the date that you're interested in, go to whatever call you're looking at. So $62 call, you want to buy this call, you have about a 30% chance of this $62 call actually hitting. So you would buy it, and you have a 30% chance of this call actually hitting that $62 mark by February 12th. You're welcome.